Welcome to February edition of Casita Coalition Small Housing Workbench webinar series. I'm Catherine Peoples, Casita Coalition's board member and CEO of HPP Cares. Casita Coalition is a cross-sector, statewide nonprofit working to remove barriers to smaller and more affordable and sustaining homes. Today's webinar will look at current efforts to improve and expand ADU financing options. We'd like to thank our major sponsors, Wells Fargo, the San Francisco Foundation, and CZI, as well as our renewing sponsors, AARP of California, the Law Office of Allen, Matkins, and Rubin, Junis, and Rose, and our most recent sponsor and premier member, Arogas. To save time, a link to the event schedule will be placed in the chat, as well as the presenters' bios. Before I hand it over to the next presenter, we'd like to give the floor to Lily Stephanopoulos from Self-Help Federal Credit Union.
Renify offers financing based on the after renovation value of the home. A Renify loan can leverage up to 90% loan to future value with a cap of 125% of loan to current value. This is nearly 7 to 11 times more than a traditional lender. There's no draw phases and no inspections. The homeowner will receive 100% of the funds at funding. No refinance of an existing mortgage. And for our California friends, we have a unique ADU product that allows the projected future rental income to be used against DTI requirements. Contact us today at learnmore@renify.com.
Without further ado, we'd like to hand the floor over to our first presenter, Lillian Stephanopoulos from Self-Help Federal Credit Union. And I do apologize to our sponsor, the Casita Coalition, Renify, providing us that commercial.
Okay, thank you, Catherine. I am Lily Stephanopoulos. I'm the Racial Wealth Gap Initiative Coordinator at Self-Help Federal Credit Union, focus on our ADU programs. We are a community development financial institution with a presence across the state of California and nationally. So we're really excited to be here. I was asked to share about our ADU loan programs and sort of what shape do they take and what are the lessons that we've been learning. So next slide, please. We were first approached to create an ADU loan product back in around 2018 through the Backyard Homes project in LA. So this was with Genesis LA and LA Moss. And their goal was really to sort of create a comprehensive program that would provide technical assistance to homeowners and reduce the cost of building an ADU by doing things like providing kind of preset designs and reducing design costs and other factors. And part of their vision was to have a preferred lender who would sort of, with guarantee support from Genesis LA, be able to provide expanded underwriting terms to make this product more accessible to moderate income homeowners in order to provide Section 8 housing through ADU development. So, working closely with Genesis LA and LA Moss, we decided to create a first lien cash out refinance product. So you take out the first mortgage and that cash out is used to build the ADU. In terms of which levers we tried to pull, we decided to go, what we thought was relatively high on LTV. So loan to value, we'd go up to 90% of the subject to completion value. We would include up to 75% of the projected future rental income for qualifying for DTI, for debt to income. And there were other features as well, such as the rental gap assistance. So essentially bridging the gap until someone had that rental income coming in so that their mortgage payment didn't go up until that income was coming in. And the program also had a pre-development grant pool. So assuming someone doesn't have like $25,000 in cash sitting around, we were able to front that through this grant program and then incorporate it into the loan amount. So there were sort of all of these features in place to try to make this more accessible and more feasible for folks who are trying to fully finance their ADU. A few of the things that we learned in this pilot, like one of the big things we saw was that and we've seen this in our future pilot, in our sort of pilots that I'll talk about in a minute as well, is that, you know, the pipeline for these programs is very funnel shaped. You have a ton of interest from people. They want to build housing. They want to, they want to support their community. They want to have another stream of income. But these are very expensive projects. They require the right kind of site. They require you to be able to finance it. And so you sort of whittle and whittle down until you only have a few loans from sort of a large pool of interest. And one of the key problems we ran into was the future value appraisal. So essentially, we were not seeing as much out of the future value as we thought we would. And we thought, and I know this is something that lenders across the state are seeing. And so that really limited the equity that someone could take out of their home in order to build the ADU. So we sort of were thinking about that going into our next pilot. If you could go to the next slide, please. So following from this product in LA, we were approached by the Keys to Equity program in the city of Oakland. So this is a collaboration between the Chan Zuckerberg Initiative, Richmond Neighborhood Housing Services, and the city of Oakland, which is really focused. It sort of has a different focus than the Backyard Homes program, which was more focused on kind of developing Section 8 housing. This program is really focused on wealth building and anti-displacement in Oakland for homeowners, and saying, okay, you know, housing creation is a great side effect of this, but we're really focused on the homeowners. And so, you know, one of the lessons that we learned, like I said, was about appraisal. So we said, okay, we're going to largely take this same product, this first lien cash out refinance, and we are going to go up to 100% of the subject to completion value, in addition to all those other features that we had. And really try to see if we can move the needle here. We launched into an extremely challenging environment, which was that historically low interest rates were shooting up from the day that we launched. And so, you know, that's one of the big things we've had to deal with is folks having a 2.5%, 3% first mortgage, and it doesn't make sense. First of all, it doesn't make sense to refinance into a higher rate, and second of all, it really reduces the amount of debt that you can afford, right? So it's really an affordability issue because these ADUs are expensive. You know, they're big investments, and it can be challenging to qualify as interest rates rise. And you know, we've really been seeing and trying to iterate through this Keys to Equity program. We have sort of various cohorts, and we're trying to kind of adapt the product based on feedback from the applicants, from our partners. And we're seeing both folks who are very high equity, but lower income, and folks who are very high income, but also have a lot of debt. So those are sort of two different challenges that we've been trying to address, and sort of trying to figure out how can we reach as many people as possible with this product. You could go to the next slide, please. So, you know, one of the big changes we're in the process of making right now is saying, you know, we don't think this interest rate environment is going to change anytime soon, but we still believe in our product. And so question is sort of how can we adapt and change? And so, you know, we had originally gone with the first lien product for two reasons. One, being the fixed rate. We find that, you know, when financing is tight, having a predictable interest rate for the life of the loan is extremely important for success. The other is that, you know, we are a portfolio lender, we service our own loans, and we want this to be a wealth building tool and sort of a new source of income for homeowners and not a path to foreclosure. And so we know that, you know, when we're in first lien, when we're in first position, we have sort of control over that process. That said, if it's not the right environment for that, we're open to changing. And so we started exploring a second lien product. It has pretty much all of the same characteristics of the first, but slightly lower LTV. We're going up to 90% of the subject to completion value. And instead of our sort of previous rental gap assistance, we're doing an interest only period during construction, sort of to the same effect, to say, you know, we don't want you to really raise your payments until you have that rental income coming in. So this is launching sort of as we speak. We don't yet have a sense of how it's going to do. I am cautiously optimistic that it will do well, and we'll sort of be able to test these other features we've been hoping to test. One of the questions that I was sort of asked going into this panel is, what are the sort of broadly, sort of from our own experience, what do we think are the things that need to change in order to support sort of broader financing of ADUs? And I think there's a couple things I had in mind. So, we have been able to test these products sort of with guarantee support. And our vision is not just for self-help to be sort of the ADU lender, right? Our goal is to sort of see how products perform, share that information with other lenders, and for these to be adapted more broadly. Oh, I got my 2-minute warning. Okay, so these to be adapted more broadly. And in order for other lenders to test this, we think there needs to be guarantee support for more lenders. So that is a place where funders, where governments can step in and say, okay, we can have loan loss reserves or some sort of support for this expanded underwriting. The second piece is that, as a lender, you're sort of midstream through the process, right? So there's certain levers that you can pull, and you can say, okay, we can go this high on loan to value, and we can go this high on debt to income, and we can include this in underwriting, and we can include that, but that only goes so far, right? And at the end of the day, these are very expensive units, right? And they're big investments for a lot of people, and you need the income to support that. You need the equity to support that. So you can sort of only pull so many levers. So something that I would really like to see is more either low cost debt or grant capital that gets sort of blended into these loan products. So whether that's, a second lien or third lien 0% deferred or forgivable loan, whether that's more funds like the Cal HFA ADU grant funds. I think we really, for folks who are trying to fully finance an ADU and don't have tens or hundreds of thousands of dollars of cash to bring in, I really think we need to see that kind of subsidy blended into the product in order to kind of reduce the cost burden and make this feasible. And to me, that's really a win-win, because you're not only creating housing, but you're also creating new streams of income for households who could really benefit from it. So that's all I'll say on that. I'm going to pass it off to Sandra Adamatis of the Appraisal Institute in a recorded segment. Thank you.
Good morning. My name is Susan Brown with Core SGB, and I'm very pleased to introduce this morning Sandra Adamatis, the president-elect for the Appraisal Institute. Sandra is going to be presenting information this morning about challenges and solutions for ADUs. There are areas that the Casita Coalition and our partners are researching to help improve financing options for property owners who wish to build an ADU. With that, Sandy, I'd like to turn it over to you.
Thank you, Susan. I'm going to make my slides available after the presentation, so I won't go into great detail on all the slides, but the first one here just goes into the different definitions by the underwriting, their guidelines, like Fannie Mae, Freddie Mac, FHA, and VA. And then the Dictionary of the Appraisal Institute's definition. And you'll see that they have many different, definitions. So the most common definition, though, is that an ADU has a kitchen, a bath, a sleeping area, separate entrance. It is shared with a primary unit structure and has the same ownership as a primary structure site. Some of the confusion created is at the local jurisdiction level, where your zoning ordinances throughout the country define an ADU differently, or they call it a different name. So that creates some confusion in the real estate ecosystem with agents and appraisers. We have a number of challenges. There's two slides here on challenges that we'll want to focus on, and that's supporting market acceptance. And that means underwriters or lenders want us to identify, does the market accept these in that particular neighborhood or market area? And the units that were built without a building permit, there are quite a few of those in our older cities, and that creates some issues trying to address those built without a building permit. Fannie Mae and Freddie Mac will accept those or will do a financing on them, but FHA and VA will not. Units that do not meet the current zoning ordinance, used to be you couldn't finance those through Fannie Mae or Freddie Mac, but now you can. The guidelines have changed. So the appraisers that are appraising these units need to be up to date on the new changes in the guidelines. There is heavy penalties for some ADUs that don't meet these building codes or that were built without a permit. So one of the things the coalition could do is to seek to find ways to bring these into conformance without heavy penalties to the owner. Some cities have done that, and that will be most helpful in financing. And in supporting the value of an ADU, the appraiser needs to be able to find that data. And a lot of your MLSs do not have searchable fields for ADUs, or they call them something different. So that's another area where we need a lot of help there to identify sales and listings and rentals of properties that have accessory dwelling units. So again, that goes into that no standard name for ADUs around the country. I think I listed more than 50 names that I found around the US and advertisements in MLSs and public resources. Another area that the coalition could help on is the way the assessor property record identifies an ADU. In some market areas, I found them listing ADUs as sheds. So again, that makes it very hard for an appraiser or an agent to search through public record and find properties that have ADUs with them. And again, there's a big lack of knowledge, and that's in the entire ecosystem, not just appraisers, but real estate agents, even lenders and underwriters have a real lack of knowledge of ADUs. So there needs to be a lot more education available to all the ecosystem of real estate. And there's even, like I say, a limited lender knowledge. So when a borrower goes to the financing company, the lender, the borrower needs to be very clear that this property has an ADU, so that the borrower or the lender can hire an appraiser who has knowledge about that property type. If they don't let them know that ahead of time, chances are an appraiser will be hired that has no education in this property type, may not even be geographically competent. So it's important that the borrower identify this property to the lending agent when they arrive. On the legal versus the legal conforming versus illegal non-conforming ADUs, not, like I say, not as big an issue in California, but around the country it is. FHA or HUD and VA will not finance a property that has an ADU that didn't have a building permit or that's not in compliance with zoning. The lender must verify that the hazard insurance will insure over these properties. So that's another area the coalition could work on, the insurance companies. If you have an illegal use, will the insurance company cover that property if there is severe damage to the property? Fannie Mae and Freddie Mac will allow these on a conventional loan, but they require the lender to check with the insurance company to make sure that they will insure over it. If they won't, that could create a problem for financing. So important items that the appraiser needs to be aware of, and this is particularly important in California since you've had so many changes in the last few years on ADUs. It's the highest and best use consideration for the appraiser. Do zoning changes over time increase the ability to add ADUs to an existing or new construction market? The answer is yes in California. And you can add up to 3, I believe, on a single unit property. However, Fannie, Freddie, FHA, and VA will only finance a property with 1 ADU. So that creates a little financing issue from that perspective. If the zoning is changing in a market area, the appraiser needs to understand how quickly will it be before it goes into effect. So that's something that needs to be well advertised and disseminated into not only the real estate agents world, but also in the appraiser's world. And have ADUs been discussed at the governmental level, like the Board of Supervisors or the county elected officials? What's their thought on it? Are they in favor of ADUs or not in favor of it? Something the appraiser and the agents need to understand. And then, does the local market accept ADUs in the different neighborhoods? Something else the appraisers need to identify within their appraisal reports, something required by the lending secondary market. And there is sales comparison approach that is the most reliable approach in most cases. And now the guidelines for lending have given us some more flexibility. They used to be very, very strict, which made it very difficult for an appraiser to appraise a property with an ADU. But now they allow us to use dated sales, old sales. I can go back 2 or 3 years and find a property that's similar and that has an ADU and make a market condition adjustment. They allow us to use active listings and pending sales to support the marketability and acceptance, to show that there are properties in that market with ADUs. And they allow us to include a traditional comparable, one that's a very similar property without an ADU, and just support an adjustment for the ADU. So those are some changes that are very positive in the market. And supporting the value of an ADU, they expect us to use what we call paired data sets, where you're comparing two properties, one without an ADU and a very similar property with an ADU. What's the price difference? And then they also allow us to use, as a secondary method, the cost approach. But that cost approach has some difficulties, but we can use that as a secondary method as well. Another method that appraisers use is sensitivity analysis, where we're looking at a number of appraisals and we're making all the adjustments we know and looking at the difference in the sales with ADUs versus the sales without ADUs, very similar to paired data sets. We teach all these in the course that I wrote for the Appraisal Institute. The income approach is rarely ever useful because supporting the gross rent multiplier, which is a sale of a property with an ADU where both properties were rented, the primary house, the ADU, to develop a true GRM. So that typically is a very difficult approach to value and not one we have found as being most useful. Discussing the payback period, a buyer should be concerned about that. If you're going to pay more for this property because it has an ADU, can you rent out the ADU? If so, how long will it take you to recoup the extra money that you paid for it? So that's a function of financial feasibility that the appraiser could address. Cost approach cannot be your primary method of supporting the value of the property or the ADU. And it has its weaknesses in understanding depreciation and supporting it. Again, you need sales to do that, so it makes it very difficult to use a cost approach that is considered credible. Your sales comparison approach is going to be your best. So actionable items that will improve the marketability and financing: zoning changes to allow ADUs, which California has been ahead of the game on that one. Grandfather in your ADUs that were built illegally. Add searchable fields to your MLS, to Zillow, to Redfin, so that appraisers and agents can find the ADU sales. Educate the public and the entire real estate ecosystem on what an ADU is and what the benefits are to the market. Lenders and appraisal management companies should be, you should enforce the choice of appraisers that have had education in this topic. And the Appraisal Institute has a list of appraisal courses on valuing ADUs. The course is one that I wrote. You have one coming up in California on Thursday, February the 16th. So I will say that in California, one of your biggest problems I see that you'll run into is the cost to build one or to add one to a property, because cost is not always equal to market value. So having an appraisal done that will be equal to cost to build is going to create an appraisal gap. So the property owner will need to have that difference in cash in order to finance that property if the appraised value does not meet cost new. With that, there's my email and my phone number, and I'd be glad to answer any questions that anyone might have afterward. So thank you for having me here today.
Thank you, Sandy. That's very valuable.
And next up, we have Andy Nguyen of the CRMLS, the California Regional Multiple Listing Service. Andy.
Thank you, Celeste. Good morning, everyone. My name is Andy Nguyen. I'm the Director of Data Services for the California Regional Multiple Listing Service. CRMLS is the largest multiple listing service in the nation. with over 110,000 members in the state of California. We have over 15 participating data shares within the state, but we also have a data footprint out to Beach MLS and Bright MLS, which serves the East Coast community along that region. I'm very excited to be part of the panel. I was invited to kind of share some of the challenges that our members face with regards to entering and sharing ADU information within the multiple listing service. So back in October of 2021, we did our redesign, but prior to that, some of the challenges include, in terms of the collection of the ADU information, it was very inconsistent across the board. So agents would oftentimes have to enter ADU information in the property description of the listing, sometimes the agent remarks and other remarks field. There were also a very limited number of ADU related fields that was kind of buried within the listing input form. And we can go ahead and move to the next slide, by the way. And so, so those are really, it just makes the searchability, and it was very counterintuitive to locate those things for both our members as well as our appraiser community. And so we had an overwhelming number of requests to kind of take a step back and redesign how ADU information is managed within the multiple listing service. And this is also in light of just really the growing necessity of affordable housing and just really improving the valuation of homes with ADUs. We can go ahead and move to the next slide. And here's just a look of how that looks like today within the multiple listing service. You can see this is a much more really scalable approach. This is the listing input form that our members go through when they add a listing into the MLS. You can see that on the top, this navigation bar, they just page through various input forms, but eventually they'll get to the ADU portion of the input process, and they'll answer a simple question of, is there an ADU, yes or no? Upon setting yes, there'll be some additional required fields that will light up along with some optional ones. But the key thing here is all of the ADU fields are completely self-contained in this area, and you can add more ADU entries and different types of ADUs, such as a JADU or a standard ADU in this section. The other thing I want to point out is this also allows us to, in the future, if we feel the need to add additional fields, we can do so without really contemplating where to put these fields, because it will just go straight in this section here that you see. We can go ahead and move to the next slide, please. Here's a look at how the reports and displays will appear to our members and out to our consumer community. You can see how you input it is really how it's going to be organized on the display and reports. So it's very straightforward. And also I want to mention that the vendor community, such as the Zillow, the Redfin, Realtor.com, as well as even just agents, IDX website vendors, they can access this ADU information as a resource, such as just like open house information that they access today. So it's treated no different. It's a separate resource, it's very clean, and you're able to tie it back to the actual listing record itself as well. So it's just the ease of use is it just makes it very easy for the vendor community. We could go ahead and move to the next slide, please. So I want to share a bit of some key stats with the group here. We went live with this new redesign back in October 2021. We've had over 3,000 ADUs, listings with ADUs added into the MLS since then. About 15% were JADUs, and the rest were standard ADUs. We're seeing approximately about 200 new ADU listings added on a monthly basis, and that number continues to rise month to month. And so really the next step for us here is to take this framework and working with organizations like Casita Coalition and some of the other partnering MLSs to bring forth this framework into RESO, which is a national real estate standards organization for adoption. And we're hoping to bring value to the real estate community that way. And that concludes my portion. I'm going to go ahead and hand it off to Kristen Correa with Caliber Home Loans and Carmel Sella with Wells Fargo. Thank you, guys.
Thanks, Andy. I'll start us off, and I'm Carmel Sella, Senior Local Government Relations Director at Wells Fargo, and I'm based in Los Angeles. And as Andy mentioned, I'll be presenting today with Christian Correa from Caliber Home Loans. We're here today on behalf of LA Project Reach's ADU Subcommittee, which also includes Beth Castro from the Office of the Comptroller of the Currency and Dottie Shepek from Specialty Mortgage Product Solutions. First, I really want to thank the Casita Coalition for its incredible leadership in advancing awareness and adoption of ADUs as a housing solution, as well as for the opportunity to participate in today's webinar. We really wouldn't be here today without the groundwork that Casita Coalition has done, and we're very appreciative. In our presentation today, we'll be providing the context of our work and then turn to the nuts and bolts of our recommendations. By way of background, our ADU work is part of Project Reach, an initiative launched by the Office of the Comptroller of the Currency in 2020 to address equity issues following the murder of George Floyd. Project Reach started as a national initiative and brings together leaders from the banking industry, national civil rights organizations, business and technology, all coming together to reduce barriers that prevent the full, equal, and fair participation in the nation's economy. LA was the first local Reach initiative and complements the ongoing national Reach work. LA Reach focuses on small business development, revitalization of minority depository institutions, and affordable homeownership. In all of these areas, Reach focuses on equity as it relates to low and moderate income communities, as well as low and moderate income communities, as well as minority communities. Next slide. Our ADU subcommittee was formed in July of 2021, and LA was really the perfect place for this work. There's so much already taking place, and we are really dedicated to advancing the activities in this region. Our work has focused on the principal issue of how to increase the availability of ADU financing and make it more accessible to a broader spectrum of home buyers and homeowners. We sought input throughout this process from numerous stakeholders, including Fannie Mae, Freddie Mac, HUD, CalHFA, as well as experts from the Turner Center and Urban Institute. Our work has culminated in the development of a white paper that will be available on Casita's website that we released last September that provides a roadmap for ADU financing strategies. Our objective in the white paper is to prompt debate and discussion and present new approaches to this challenge. Next slide. We viewed ADU financing through the lens of ADUs being an invaluable resource for increasing housing inventory in California and nationwide. We heard from Andy from the MLS, the volume of ADU activity, and it's been estimated that if only 10% of eligible homes in California add an ADU, we would see an increase of 900,000 units of housing, and some put the estimate closer to 1.5 million new units. And we also importantly have viewed ADUs as an important community stabilization tool to address gentrification in so many of our communities and enable homeowners to remain in their home by providing supplemental income. Yet despite the potential benefits of ADUs, the central barrier over and over again of getting to scale is the challenge of ADU financing, and has been alluded earlier by Self-Help Federal Credit Union. This challenge has been exacerbated by the current higher interest rate environment, which limits refinancing as a financing tool. Our focus, therefore, is on what other models are needed and what regulatory and other changes are necessary in order to maximize ADU's potential. Next slide. In developing ADU strategies and really thinking through these issues, a key factor for us has been the need to consider current GSE government-sponsored entity policies, primarily those of Fannie Mae and Freddie Mac, which don't currently allow the future income of a yet-to-be-built ADU to be used as qualifying income for a mortgage or to finance an ADU. However, we were really thrilled when, in the course of our drafting the white paper, Freddie Mac issued a new policy change which recognized ADUs and for the first time has allowed rental income of an existing ADU to be used to qualify for a mortgage, as well as finance other changes needed on the property. But there's an important caveat that with that change comes criteria and restrictions, and requires a full appraisal. And we've heard about the issues associated with that, as well as a lease and landlord education. But it is an important first step and shows the recognition of GSEs of the importance of ADUs. Throughout our work, we've been very mindful that on the issue of ADU financing, one size doesn't fit all, and that different homeowner and home buyer scenarios require different financing strategies. I'm going to turn this over now to Christian, who will walk us through these different scenarios and the white paper's recommendations. Christian?
Thank you, Carmel. And what I'm going to do is walk through, if you don't mind advancing the slide one, please. So we're going to go through the current ADU home buyer and various home buyer scenarios, homeowner scenarios, I should say. Scenario number one is a current homeowner wants to build an ADU without changing their current first home mortgage. We've lived through historical low rates, and scenario one is, as we've alluded to, has been popping up from time to time, and more so. Scenario number two, homeowners who own free and clear without a mortgage, taking out a first mortgage to build an ADU. Scenario number three, a current homeowner will use cash out a refinance to build an ADU. Scenario number four, the construction of a new home along with the construction of an ADU. Scenario number five, purchase of an existing home with an ADU that is already rented. And scenario number six, purchase of an existing home with an intent to build an ADU. So those are the current scenarios that we walk through, and you also find in the white paper. Next slide, please. So our subcommittee recommendations include, number one, the GSEs should allow ADU income to be factored into a borrower's income qualification. We've heard that from others on the webinar so far as well. Number two, revise GSE appraisal forms to note ADUs on a property. Again, also alluded to on the webinar. Number three, include ADU construction and landlord education as part of the financing offering. The reason why we added this section was because we realized through our interviews that a lot of the folks that were contemplating an ADU were going to be new landlords, and that landlord education was going to be needed. Item number four, governments and nonprofits should consider providing subsidies in the form of grants or down payment assistance for low to moderate income home buyers purchasing a property with an ADU or contemplating building an ADU. Next slide, please. What you see here is our proposed ADU financing pilot. Our recommendations bring together interested parties to conduct the pilot. Timing expectations must be managed as all partners gain approvals to engage. And we've learned this throughout our conversations with LA Reach and other stakeholders. Item number three is ensure data capture methods are developed to quantify the success of the pilot and potential to replicate. Again, we've heard this from our GSE partners that the data is really what's of high regard and high priority. Next slide, please. This will give you a step-by-step and a little bit more detail into our thought process of developing this pilot. So number one, identify a geographic area within the scope of LA Reach where favorable zoning can be leveraged to offer an innovative ADU financing pilot. That's number one. Number two, identify 3 to 5 mortgage lenders interested in testing the ADU financing product for origination. This could include mortgage bankers, commercial bankers, CDFIs, or other nonprofits. Number three, ensure that lenders' warehouse lines will allow participation in the pilot. That's very key, number three. Number four, identify a takeout lender willing to buy the mortgage loans once closed. This could be one of the originating lenders or named master servicers or HFA. Number 5, partner with a mortgage insurance agency to create acceptable risk variances. Number 6, gain support from local appraisal oversight team to issue guidance on how to determine the after improved and with ADU value using the income approach as one component of a comparison approach. And we've heard other comments prior to on the webinar as well. Number 7, create guidelines, which include checklists, policies, procedures, audit and loan servicing practices specifically to ADU financing. Number 8, identify a loan servicer or outsource provider with a willingness and ability to manage the construction process, provide construction approval, property inspections, fund disbursements, change order and approval, process of loan modification if needed, and convert the loan to permanent. Number 9, identify GSE or private investors of whole loans and potential investors of MBS backed for specific percentage of ADU loans in the mortgage loan pool. And final, number 10, partner with a local nonprofit housing counselor who will provide critically needed landlord education to homeowners, as mentioned before, because a lot of people are taking this endeavor for the very first time. So we want to make sure that they're successful in their journey. And next slide, please. Our conclusion, 4 bullet points: piloting a scalable financing option and allowing sufficient time for the program to yield results will be a major first step in advancing ADUs. Number 2, ADUs have the potential to fundamentally alter the landscape of housing availability in Los Angeles and help promote community stabilization. Number 3, new models of home financing and appraisal standards are needed to fully realize the potential of this housing solution. And last, addressing the challenge of ADU financing will take innovative and new approaches to mortgage lending. For more details in our findings, please reference our ADU white paper. Casita Coalition will make that available to all. With that, I'm going to turn the mic over to Susan Brown at Core SGB. Susan.
Thanks a lot, Christian. I appreciate it. Good morning. My name is Susan Brown, and I am the founder and CEO of Core SGB, where I help innovate ideas to help connect community and capital. I'm going to broaden my comments a little bit to include middle housing generally. That's a new expanding area that has launched very nicely off of the ADU journey that we've all been on. Could we go to the next slide, please? I find this graph very enlightening. It's information provided by Ion Housing, which shows us the remarkable change in production of middle housing units following the Great Recession. Most traditional capital providers turned off the flow of capital to small builders who focus on these property types, and that capital has yet to be restored. While zoning to allow this property type has become more liberal, as we've talked about many times in these presentations and over the years with the Casita Coalition, the available of capital has not kept up. Can we go to the next slide, please? Available capital remains a stubborn hurdle for middle housing, and we've talked about that again. It's a common theme throughout our comments here today. Many of us are familiar with the home style, choice home, and 203K renovation products for adding an ADU to an existing single-family property. In some cases, these loans are even available for investment properties. With the rise in interest rates, though, over the last year, these products have become a lot less appealing. Nobody is interested in giving up their 2% and 3% mortgages for a new 6% renovation loan. Less familiar is the construction to permanent loan for newly constructed 1 to 4 unit properties. And Christian mentioned those in his comments earlier. And those are available for either owner occupied or investment purposes. Fannie Mae's program has no guideline restrictions for occupancy. They are available for owner occupied and investment, but very, very few lenders, if any, offer the loan for anything other than owner occupied single family properties that can include an ADU. The C2P loans are generally available to individual borrowers and not companies. So the program is there to create these 1 to 4 units in theory, but it is currently not widely used at all. While 1 to 4 unit properties fall into consumer lending, 5 and 6 unit properties fall into the commercial lending category. These loans are generally a little more expensive, including higher origination fees and higher interest rates, and they're offered to experienced builders who will either sell the properties upon completion, pardon me, we know that as spec projects, or they keep them for their own investment portfolio. It's difficult to obtain these loans without prior general contracting or development experience. And most lenders, again, have yet to embrace spec lending following the Great Recession, so the money is pretty hard to come by. Right now, private equity firms who offer short-term construction financing are one of the most reliable sources of capital for this use. As the Turner Center paper of February 15th tells us, multi-unit properties are more financially feasible for developers and builders to create. The added units allow developers to achieve economies of scale by building more than just 1 or 2 extra units, which is key to unlocking missing middle housing construction. With more available capital and more liberal zoning rules, more production is possible. Another noteworthy challenge is that as municipalities liberalize their zoning rules to allow for multiple ADUs on a property, the financing options lag. Agency loans, also called conventional loans, offered by Fannie, Freddie, FHA, and VA, allow for 1 unit and an ADU. Those programs don't currently allow for 2 main homes or multiple ADUs, even as zoning laws have allowed these combinations. So we've still got a gap in the financing, keeping pace with the changes that are happening at the zoning level. And another struggle I wanted to mention is the efficient subdivision of lots, especially those with current liens on the property. The steps are complicated and expensive, particularly if there's a lien on the property. Homeowners must get a survey of the new lot, the cost of which is multiple thousands of dollars. A new appraisal is also required to demonstrate that the existing building and remaining land has sufficient value to support the existing loan. And then the homeowner has to get permission from their existing lender to release the newly formed lot from their loan if the value is high enough. So it's a long process that is expensive. Next slide, please. In spite of the challenges, there are some promising things taking shape. Recently, Freddie Mac added into their guidelines that allows for using rental income to qualify borrowers for their loans, which was mentioned earlier. However, as also mentioned, this for existing ADUs. We still have a gap for creating new ADUs and being able to allow that rental income. Another promising sign is that more lenders are beginning to launch a construction loan program, and some are even opening their programs for smaller housing types. Credit unions and independent mortgage banks and CDFIs especially fall into that category. It's common in lending for a few small players to lead the market to more broad acceptance, and hopefully these small lenders will be the catalyst for bringing the larger lenders back into this space. Some lenders, like Lily and her organization at Self Help, are creating second equity construction products that allow borrowers to keep their low interest rate first mortgages in place and take advantage of their equity and increased property value realized with the property improvement. Some of these loans are advanced as the construction progresses, and some allow borrowers to advance the entire loan balance before construction begins. I've mentioned before that private equity firms are in this space, and they're beginning to open their portfolios to a broader range of lenders. It's temporary financing, but that's the gap right now: capital to create units. There's really available capital to refinance or purchase these properties. It's expensive, so demand is low, but the money in the programs are there to do it. It's just that creation, that's where we have the biggest gap. One more thing to think about. Agency loans allow for construction of detached condos. Perhaps that's an underused resource that could be leveraged by some homeowners to create properties with a main structure and an ADU that could be condominiumized and then sold as individual properties later. Next slide, please. Some things that we can contemplate as we make progress in the financing arena. There has been some talk about developing a mortgage insurance product for second lien construction loans. I know of one company that's exploring the idea, but it takes time and statistical data for an insurance company, big insurance companies, to determine the risk and develop a profitable pricing structure that the marketplace will accept. If the price is too high, nobody's going to buy it. Another area that I've been thinking about is how the Community Reinvestment Act might help us in this area. For those who aren't familiar with CRA, it was enacted in 1977 and requires the Federal Reserve and other federal banking regulators to encourage financial institutions to help meet the credit needs of the communities in which they do business, including low and moderate income neighborhoods. The idea of the CRA and its implications is gaining broader attention throughout the country and is being tested to potentially include independent mortgage bankers, which it has not encompassed before. Independent mortgage bankers aren't depository institutions, so they've been exempt from the requirement in the past. The increased focus on CRA may be an area that can produce pressure to encourage more innovative lending for smaller housing. It's being challenged at the state level, not on a national level yet, but it is a very live issue in California. And for those of you interested in that space, it's a good time to explore it a little bit more. Finally, I want to wrap up with a call to action. Many of us in the lending space have been frustrated that the 203K loan program can be used to modify an interior space or add an attached ADU, but the loan doesn't currently allow for the addition of a detached ADU. This invitation for feedback is a great time to help HUD understand the benefits of modifying the charter to allow for this kind of a project. So I hope that anyone who is able to will produce a comment and submit that to the Federal Register so that FHA can understand how we might be able to better utilize that program. That concludes my comments, and I'd like to pass this off to our final presenter, Jennifer Palmer from the County of Napa. Thank you.
Hi, my name is Jennifer Palmer. I am the Director of Housing and Homeless Services for Napa County, and I'm going to provide an overview of Napa County's Affordable ADU Forgivable Loan Program. Our Board of Supervisors approved the program concept and structure in late November of 2022. And since then, my team's been working to finalize our program contracts, the application portal, and our loan documents. And we're on schedule for a full launch at the end of this month. If we could go to, I think probably the next slide and then the next slide. Perfect. So my presentation today is going to give a broad overview of our major program elements, including what it is, who is eligible and under what terms, the application process we've developed and the funding that we're making available, a very high-level demographic look at who has applied so far, and an overview of some of the next steps for our program development. I also want to note I am the one speaking, but I'm joined by Scott Johnson from the Napa-Sonoma ADU Center. Napa County has had a multi-year partnership with the Napa Valley Community Foundation and the Napa-Sonoma ADU Center to innovate around ways to support our local homeowners with ADU development across the county. This loan program is one of many things that have flown from that partnership, and the work that Napa-Sonoma ADU Center has done in the community is quite literally the foundation on which our county's loan program has been built. We can go to the next slide. So our program is at its core a forgivable loan to build a new ADU that is kept affordable for 5 years. What it is upfront money to help lower the cost of financing the construction of the new ADU in exchange for a short-term affordability covenant. It's scaled to the size of the ADU and meant to cover the gap between market rate and affordable rates over the period of the affordability covenant. So in essence, it's fronting the difference for the homeowner to use the capital now toward the cost of building the ADU. The program also includes some incentives, which are basically just additional amounts for the loan, for using or obtaining certain services that either are required by the program or available to help homeowners to streamline or finance the building process. In total, our supervisors allocated $6 million in funding to initiate the program. $5 million of that is meant to be in direct loans, and $1 million is in program support for various technical assistance contracts and staff support to run the program for the first couple years. It is using county general fund, although I will just note that the ARPA funding was sort of the enabling environment. It was this one-time new influx of capital that came into the county. We're not using ARPA funding for this, but that was functionally the change in the capital influx that allowed us to bring this program to market. So if we could go to the next slide, who is eligible and under what terms? For homeowners, the answer is a homeowner living full-time in their single-family residence who builds a new ADU and commits to renting it at an affordable rate to households earning up to 80% of AMI for 5 years. We do not have an income threshold for homeowners right now. The only requirement is that they commit to the affordability covenant. For tenants, eligible tenants are any household earning up to 80% of area median income. Tenants can be family members of the homeowners as long as they meet the income requirement. And we will have income certification as a lease up at the start of their lease. We will not have a re-verification process if the same tenant multiple years in a row releases. So no penalty for increased income over the course of a lease. However, with each new tenant during the 5 years, every new tenant will need to income certify. The terms of the loan, it's a 7-year loan with a 5-year covenant. At the point of that being, we're giving them 2 years to build the ADU. And there is 3% simple interest, which is deferred. Forgiveness is calculated annually based on the number of months in compliance. Homeowners have an opt-out penalty at any time without paying a penalty. They will just pay the balance. And if there is a balance at the end of the loan term, owners will have the option to either extend the covenant for an additional year or just to pay off the balance. So what we're allowing for there is that tenants may depart. It may take another 2 months for a new tenant to lease up. So there might be a few months of non-rental over the course of the 5-year covenant. And so we'll have a mechanism to either allow homeowners to pay off without penalty or extend the covenant. For monitoring, we will, as I said, do income certification at lease up and with any new leases. Other than that, annual monitoring will include confirmation that that tenant is still in the unit, and then calculating the months of compliance and issuing a forgiveness letter. We could go to the next slide. Our application is a 3-step process designed to move at the pace of the project so that the loan is funded when it's ready to be built, and that we've provided a healthy amount of technical assistance along the way. Step 1 is basic registration via our online application portal, for which we are using Neighborly software. Registration involves providing some information to confirm eligibility and a little bit of information about the intended project. Homeowners are then referred for a feasibility consultation with Napa-Sonoma ADU Center. This is a mandatory step, but our program will cover the cost of the feasibility consult for referred homeowners through a contract directly with Napa-Sonoma ADU. The second step will require more in-depth information based on the results of their feasibility consult. We will, at that point, provide a reservation of funds letter for that project, and the homeowner will have 90 days to secure the rest of their financing and secure managed construction escrow services. They will also be referred for 3 online classes covering ADU construction, financing, and landlord-tenant dynamics. This is another contract we have with a local provider who is developing those courses, and they will be online courses. They'll be like a curriculum management class, so they'll have to register for the class, take a quiz afterwards, and upload their certificate of completion into our application portal. And finally, step 3 extends another 90 days to secure permits and construction contracts and sign loan documents and affordability covenants to fund the loan. I will just note this is brand new for us, so the 90 days for each of these are based on what we understand to be a reasonable period of time. We do expect to provide lots of extensions for folks. This is a learning process, but we're starting with these 90-day windows. We can go to the next slide. For what we're offering, it's a base loan and certain additional incentive amounts. The base loans, as I said, are set by the gap between market and affordable rent over the 5-year period of the affordability covenant. The incentives will cover the cost of either required services required by the program, or to reimburse the cost of services available to homeowners that we believe will streamline or help finance the building process. So those include the cost of using pre-reviewed plans from the Napa-Sonoma ADU Center Gallery, the cost of securing managed construction escrow services if they have to go outside of their existing lender to get those services, the cost of conventional loan closing services and fees. We are also offering a bonus for any of our homeowners who secured the Cal HFA ADU grant. We're hoping Cal HFA considers refunding that grant, and we did the program design while that grant was still available, so we're keeping this incentive there even though that program is fully subscribed at this point. And finally, the cost of permit fees for properties in the unincorporated Napa County area. I will note it's only reimbursing fees for the unincorporated area because that's the only area that Napa County controls. We are working with each of our jurisdictions to see if we can get them to match forgiveness capital for permit fees in each of the jurisdictions. Homeowners can choose which incentives they want to utilize, and the maximum combined amount of the incentives would be an additional $20,000 on top of the base loan amounts. Go to the next slide. So we haven't formally launched the program yet, and we've done very little marketing so far, except for a single webinar with Napa-Sonoma ADU Center in January. At that time, we opened step 1, the registration, and our intent was, as we worked on finalizing the loan documents and some of the other contracts and the technical assistance to be put in place, we wanted to allow folks to begin to register for the feasibility consults and get themselves scheduled. In 1 month since that webinar until today, and without any other marketing at all, we have 120 applicants in the program who we've referred for feasibility consults, so 120 eligible applicants thus far. Of that, 90% of the homeowners are seeking assistance with a 1 or 2 bedroom unit. They are spread geographically across our entire county, though the majority are in our main population center, which is in the city of Napa. The age of the applicants is incredibly evenly distributed in the 10-year age brackets between 30 and 70 years old. So there really was no one age bracket I was looking for, or more folks. Are these young homeowners who are just ambitious about building, that kind of thing? They're nothing. It's very evenly split. But the most interesting data point to me was we asked folks why they want to build the ADU. More than 60% combined said either for a family member or because they want to help the community. 30% said they need the income for their housing security long-term. And the way we asked that question had a lot to do with aging in place. Just 8% indicated that this was purely a financial, property value increase decision. And of all the data we've collected, I think this last one is important because it speaks to more than just the role of forgivable loan capital in the value of building. To me, it speaks to motivations around social connection with family and with community. It seems to really illustrate the unique opportunity of a public-private partnership to both support affordable housing development, but also to strengthen the social fabric of our Napa community. If we could go to the final slide. So next steps for our program development include working on programs to pre-screen or income certify local workforce members who are earning up to 80% AMI who are looking for local rentals. This is a huge priority for Napa County, as more than 50% of our workforce earns less than 100% of area median income. So we're a very we're incredibly expensive housing market with a really high percentage of low wage workforce tenants. So figuring out how we use ADUs to support our workforce is really what drove this program. So the next step is going to be to figure out how we help landlords who have these units access that tenant pool more simply. We're also going to institute office hours as technical assistance for all interested homeowners looking to build ADUs. So again, using as much technical assistance as we can to improve the enabling environment for any homeowner, not just homeowners looking to use our forgivable loan. And finally, to work with our jurisdictions on matching capital commitments so that we can have a second round. We've got $6 million for this round, just based on the applications that we have so far. We have more people seeking funding than we have funding before we've even launched the program. So we are already starting to think about a round two and how we'll finance that and what round two might include, which looks at, some of the other things that we would like to be able to consider for a next round would be ways to quantify the value of a homeowner moving into the ADU and renting out the main house at an affordable rate. Same with the JADU. The challenge for us, and we did not include this in our first round, is just simply that both of those have different kinds of complexity around what a covenant on the main house would do, and how we value the market versus affordable rental gap there. So that is something we hope to be able to answer in the future round. We also want to look at how we could help new or first-time homeowners with building an ADU. And finally, offering loans potentially to rental property owners with the idea that perhaps those are longer affordability covenants. But right now our program is focused on really just helping existing homeowners rather than rentals. And I think that is it for me.
Our next presenter is Joe Hoppus of Paradigm. Joe, over to you.
Thanks, Celeste. I'm Joe Hoppus, the CEO of Paradigm. Paradigm has been in existence for about a year and a half. What we do and our goal is to create more home ownership through bringing multiple buyers together to reduce the cost to acquire and the monthly payments, increasing affordability and access to home ownership. Co-buying is also called fractional. So it's just people who own certain percentages of different homes. By bringing people together and allowing them to unite their buying power, it turns a lot of no's into yeses, particularly in the millennial sector that is losing that dream of home ownership. Shares don't need to be equal. They can be asymmetric, and co-buyers don't need to reside in the home. Some can, some can't, or it can be purely an investment. Next slide. So we offer a free tool and platform to co-buyers to educate them, align, find real estate agents, understand asymmetric equity. We have a calculator that does that and measures it over time. So at any point along the journey, people can realize and look at exactly where their equity position is. We have custom software that is very interactive and easy to use. We've tried to reduce the barrier, that financial and real estate literacy down to really easy terms to take something really complicated and make it smooth and accessible. So a lot of co-buyers are going in, they're buying properties together. It's the fastest growing segment of the residential real estate market. It's was 1% of the total residential real estate sales 4 years ago. It is now up to 5% of the total residential sales. So people are doing it, but how they hold title, in tenancy in common versus joint tenancy, the education that we are bringing to the market, to both professionals and co-buyers themselves, is really critical for them to understand how to co-buy properly with protections. So asymmetric contributions are pretty easy with what the down payment is. And if a certain party brings in a certain amount, the other party brings in, like say in this example, we have one down payment that's 90,000, one's 60,000, or one's 40,000. You've got a total contribution, and we recommend breaking ownership percentage down based on your original investment. Co-buyers don't have to; they can create their own way of doing it. But that is their initial share. So you can split expenses however it works between the multiple parties. You can split it between who's living there, who is has a bigger portion of the property. Say for an example, you have co-ownership and there's an ADU on the property, and the ADU is smaller, but the utilities can be adjusted per square footage, can be adjusted per use. So we create flexibility in our agreement builder based on use and customization. Next slide. So selling a property when you're a co-ownership is easy. It's the same if both or all of the parties decide to sell at the same time. The trickier part is when one party wants to leave and the remaining people want to find a new buyer. We have found a loan that makes it fairly easy for that outgoing party to get a cash out on a refinance event when they sell to a new buyer. And in the agreement, it talks about how to redistribute, set a market value, how to create an exit, how the refinance works, and how that cash out of that exiting party happens. The nice thing about the intersection of ADUs and co-buying is if the property can't be divided into multiple units, via zoning, it can be divided into different ownership through our agreement builder. So one person can have specific use rights to the main house, and the other owner can have specific use rights to the ADU, but they can be co-owners, which opens that door for owner-occupied ADUs to have multiple owners. There's a question here, what needs to change to improve access to co-buying opportunities? I think what needs to change is just awareness that people can do this, that there is an easy way to create ownership, friends buying property together, family members buying property together. Any non-married multiple parties can do this. It's knowing that there is access to the tools to do it properly.
That's wonderful. Thanks, Joe. It sounds like such a valuable set of tools.
Thank you so much, Celeste, for having us.
So a couple quick questions.
Yeah.
So let us say that you have someone you wish to co-buy a property with, and maybe their credit isn't quite as good as yours, and they might make it more challenging to get the loan together. Is it possible to not have them on the title or on the loan and yet have them on the co-buying agreement?
Absolutely. Yeah. So the co-buying agreement lives outside the transaction. And we've had a number of parties that have come in where two people qualified for the loan, but they were co-buying with four individuals. And the down payments and monthly payments for those other individuals that weren't on title and weren't on loan are addressed in the co-ownership agreement. So it doesn't prevent those four people from buying the property, just two are on the loan and on the deed. And they negotiate and figure out how much that's worth, and what extra equity there is, and how those other two buyers are potentially buying in equity over time.
Great. So you're seeing all kinds of people take this path to ownership. I take it, like not just unrelated people, but families as well, multi-generational families.
Yeah. You've got parents buying with kids. You've got friends buying together. You've got family members buying together. And buying all different kinds of properties. We also have a lot of people who own. Our very first client was a gentleman in California who had an ADU and said, "Hey, I just built this ADU and I want to create home ownership for somebody." He was a very forward thinker, and so we gave him the agreement and walked him through how to find someone to co-invest, and it ended up not working out, but he was like, this is fantastic. And back to that question on the slide, ultimately what we're trying to develop is a loan that would allow for two people to individually qualify for their portion of the property.
Mhm.
And there be essentially a firewall inside of a deed of trust that would allow those two people to operate more independently, so that person that's coming on to buy that ADU, they are on the global deed of trust, but they have their own qualifications. They have their own responsibilities for their percentage of the property. The loan does exist. It just exists in Canada right now. And our goal is to bring it to the US.
Terrific. And that was our final presenter. Let's go back to Catherine now for the Q&A.
What a wonderful session today, all the wealth of information that we've received. I'd like to welcome all of our presenters back for a 10-minute question and answer session. We will also be joined by Abdul Malik from Quality Appraisal and Scott Johnson from the Napa-Sonoma ADU Center. Attendees, please use the Q&A feature for your questions. And if you could please keep them general, that will be most helpful for the session now. I've received a set of questions via email, and I will start off. This is a question to all the presenters for today. Have you seen changes in the appraisal value over the last few years? An example of that would be appraisers valuing ADUs more fairly. Any of the presenters can answer that question.
Well, I guess I can take that since I'm the resident appraiser on the panel. I like to often say that appraisers are kind of like Al Roker. We don't make the weather, we just report it. So when you say valuing the ADUs more fairly, I'll take that to mean maybe getting qualified appraisers to actually look at the contributory value of the ADU. I can say that the good news is there are a lot of classes being developed. Sandy, we heard from earlier, has made a very important contribution to that, and other prominent appraisers are reaching out to their colleagues to present 7-hour classes, 14-hour classes that are helping appraisers to more accurately value these properties. But every appraiser endeavors to value any property fairly. It just depends on what market data is telling us as to the contributory value of the appraisal in that particular market.
Wonderful. Thank you. Is there anyone else that would like to chime in on that question? Okay. We'll move on to our next question. This question would be for Susan. To improve financing options, are loss mitigation funds impactful and worth pursuing?
That's a great question. There's different forms of loss mitigation techniques. You can use credit enhancements, you can use guarantees, you can use mortgage insurance. There's a variety of different techniques that could be applied. I think probably the most important pieces that we're missing are statistical data to demonstrate the actual risk associated, for example, with using rental income on a property. And because loans end up being part of a big investment pool that becomes a bond that individual people like you or I buy for our retirement plans, there has to be a really measured way to understand the performance of that security instrument. And so our biggest quest right now is to try to gather together data to determine what the actual risks are associated with it so that products can be developed that have a cost that is affordable and provides the reassurance for the entity making that loan in the first place. I hope that's not too technical, but it takes data and it takes good pricing to make it an appealing product.
Wonderful. Thank you for your response. Is there anyone else that would like to chime in on that? Okay. Our next question to all the panelists. What role can home builders and developers play in promoting ADUs and ADU financing?
I'll take it. Oh, no worries, Susan.
Thank you, Christian.
No, it's a great question. And really, my first always thought comes to just awareness, education, being on panels and really jumping on webinars such as these to get educated, and then really just inviting others to join the coalition in its mission to educate, really, because it's going to take all of us to solve the crisis that we have in housing inventory.
Thank you very much.
If
I will
Catherine, I could
circle
add
back
to that just a little bit if I may.
Sorry, Susan.
That's fine. We've had some experience up here in the Portland market with our builders, particularly those involved ADUs and middle housing, becoming very, very involved in the rulemaking and legislative processes, where they're understanding what the rules are and what kind of changes they'd like to see, and really helping shape the what those new legislative rules are going to look like. So I think being willing to step into the red tape a little bit is another important way that the builders can be involved.
Wonderful. Thank you again. And Scott, would you like to chime in as well?
I would, and Susan brings up an excellent point that we see is that for most of the jurisdictions and even up to the state level, it's hard sometimes to see it from the homeowner's perspective or even the builder's perspective, and because the potential cost and risk of these projects to homeowners can be so good or so great. We're talking $200,000, $300,000, making the process easier, reducing uncertainty, reducing friction and costs wherever possible is how these things are going to become more successful. And builders are in a particularly unique position of understanding exactly where the pain points are at any given jurisdiction, and getting involved a little bit politically, or rather than just saying, okay, this is just the cost of doing business, talking to the city councils, talking to the board of supervisors, and saying, if you change this one policy, this would make things a lot easier. If you change these 3 policies, we could do a lot better with these things. That's a really special position that builders that builders are in that almost nobody else could do as effectively.
Thank you very much, Scott, for chiming in. I've got a few questions coming in different directions, so please let me just take a look. May I ask this question to all panelists? Which agencies offer loans for condominiums, which may be a resource for construction of ADUs that are then sold as condos? Does anyone want to chime in on that question? Susan, I see you nodding your head.
Yeah, as I mentioned in my comments, Fannie Mae on their construction to permanent loan product has an allowance for detached condominiums. So as we start to endeavor into these subdivided lots that can then be divided and perhaps sold with a dwelling on each property as a condominium, that could be a potential source of capital. I think there's still some catching up to do from Fannie Mae's perspective to match the cadence of the new zoning and some of the ways that these lots are being subdivided and the way that the language appears on those legal descriptions might be a little bit problematic for the agencies and specifically Fannie Mae, who allows that in their guidelines. So I think it's worth doing some exploring and really testing that as a model for how we might be able to deal with these properties going forward.
Great response, and thank you. I have a question for Jennifer, actually. There was a question with regards, what is the interest rate for the NAPA Forgivable Loan Program? Could you share that, or if it wasn't mentioned,
Yeah,
or possibly missed?
3% simple interest deferred.
Perfect, thank you. I'm going to circle back to Abdur, and please forgive me if I'm not pronouncing your name correctly, but I'd like to ask you a question with regards. HUD states in the recent handbooks instructions on how to appraise ADUs. Some states have limits to that. Are you familiar with this, and can you share with the viewing audience today?
Okay, so just looking at that question, I think they were asking a question about ADUs being used as GLA, which is kind of an important question because GLA just stands for gross living area that generally is finished above grade space that you would normally consider as part of the main portion of the home. One of the requirements to be considered GLA is that it has to be accessible from the main portion of the home. So if you have a wing to a house that you have to walk outside, potentially get wet in the rain to get to this other section, generally it's not considered gross living area. So the question comes out, if you have some of these ADUs that are attached to the main dwelling, you could say, well, why can't you just call this GLA and just value the entire property according to the increased square footage? The problem with that is it has diminished functional utility. You have to walk outside of the main portion of the home to get to this ADU, and therefore the market may penalize that type of a configuration of the square footage. And so generally speaking, Fannie Mae is going to make an appraiser separate out an attached accessory dwelling unit and have it on a different line in the appraisal report than they would put the main living space. Now, the good news is just because that is separated out, it doesn't mean that the market is valuing that space any less. That's up to the appraiser. That's up to the local market to dictate. But if the appraiser does their homework and investigate, you may find that the contributory value is very similar to regular above grade living space.
Thank you. Wonderful. I am just combing through the questions here. I think we've got some more coming in. Okay. Is there any other comments that anyone would like to chime in on as well, while I just take a quick glance to see if I've caught all the questions?
Hi, this is Celeste with the Casita Coalition, and we've got some upvotes on the question about appraising manufactured ADUs.
Now that's a really good question. Well, I can say that I actually have appraised a manufactured ADU in my professional practice up here in Portland. I can tell you that they are very rare in the market. Portland has some of the most progressive regulations regarding ADUs. They're kind of a national leader in that regard. And even up here where we have ample amounts of data for ADUs, I could not find a single manufactured ADU in the local MLS system up here. So they're very new. That's cutting edge. Some of these things are dropped in by cranes into backyards. And so the technique that I particularly used in this appraisal was I found properties with ADUs, and then I looked into the market to see what the differential was for manufactured homes versus regular site-built homes. And I got a percentage adjustment that I was able to apply forward to the ADU. So data is going to be very scarce. It's going to be very difficult. But these type of appraisals are complex. So you want to make sure you get an appraiser who's well aware of using advanced techniques. But there's always a way to figure out what the contributory value might be.
Susan, were you going to bring in some comments on that as well?
Yes, if I may. I wanted to point out that Fannie and Freddie now both allow for a manufactured ADU in a couple of circumstances, either if the main building is site built, or if the main building conforms to either the choice home or the MH Advantage manufactured home standards for the main building. So if there are particular criteria that are met, both Fannie and Freddie do allow for the financing of a property with a manufactured ADU, which is very exciting because it can significantly reduce the cost of adding that unit to the property.
Wonderful, thank you. Celeste, may I just ask if there's any additional questions that I might have missed, either in the chat? Okay.
Sure. How far does anyone think we are from Fannie or Freddie making the necessary changes that will allow ADU lending to truly scale up? I know, Susan, you mentioned that data will be needed. Is an effort underway now to accumulate that data? Is there data somewhere that we can get at that would help this along? And then the second part of that is, what do we think it would take for them to allow future rental income? And that's your question about the risk. And again, that's a data question. I guess the question is, what's the timeline looking like for there being true scale up through the agencies?
What do they say? I'm Karnak. Let's predict the future. You know, there have been some studies. In fact, the American Enterprise Institute did a study last fall where they did release some preliminary information on the delinquency rates for 2-unit properties, that 2, 3, and 4-unit properties. They compared the delinquencies of those properties either as an owner-occupied property or a non-owner occupied property. And what their findings show is that for 2, 3, and 4-unit properties, the delinquency rate was actually higher for properties that were financed as an owner-occupied property than they are for properties that were financed as an investment property. And there might be a couple of reasons for that. One is that they're using projected rental income for an owner-occupied property, saying, if I could rent it, I could get this much rent, but I don't have a renter yet. Where when you finance an investment property, you have to have those lease agreements in place. So this particular study does not bode well for including rental income if there are not substantial documentations in place. So that's one study. And as I understand it, they're going to be updating their findings at some point in the future. We know that Fannie and Freddie can look at their data and determine what the performance are of properties with 1, 2, 3, and 4 units, and trying to get that information either through the FHFA or other means would be really important for us to be able to analyze a very wide range of loans and a wide range of geographies to find out what the true performance is. Because as those loans end up in security, the people who buy those bonds need to be assured that the loans are going to be repaid timely so that they get their investment back.
Thank you. I have one more question that has come in, and I think this is good for Lily. And any of the other panelists that'd like to chime in. Would a model ADU loan for credit unions combined with a mortgage insurance product or a loan guarantee pool have the potential for significant scale?
I think that's exactly the question we're trying to figure out. So I don't have a great answer. I mean, we are, you know, we happen to not use mortgage insurance as a portfolio lender, so I can't really answer that question. But I do think that the real chance for scale, this is the way we tend to see it, is that the real chance for scale is through the GSEs. So not necessarily delivered through credit unions like ours, but delivered broadly. So, you know, we are trying to sort of contribute to this data gathering effort to determine if this can be scaled.
Thank you. And did any of the other panelists like to chime in? Okay. Go ahead, Celeste, if you have one more question for the group today.
Sure. And of course, the other piece to this question of how we can more broadly scale up and and provide access to ADU potential is the cost. So the cost of the ADU itself. So in your minds, all of you, as you are looking at borrowers and what they could afford, what is that dollar amount for an all-in ADU that would really, really open it up to a broad range of homeowners and neighborhoods? What does that look like to where we can, if the market can get it down and the innovators in the business can get it down to a dollar amount that would really make a difference? What is that dollar amount? Is it 150 all in? Is it 100? Just interested in your thoughts here, because I know people are working on this question.
Celeste, I've got some initial thoughts. I don't want to take over the conversation here, but I think it really has to do with a couple of things. Geography makes a big difference, depending on what the income limits or income levels are of the folks within a particular geographic region. If we're looking at rental income as a potential way to pay for the project, that changes based on what the income potential for the property is. Lower is better, lower cost is better, but where is that line? And I think looking at a person's ability to repay debt if they're having to acquire it, or to what extent are they willing to utilize the cash resources that they have and get paid back over time for that investment, are just so individual. It's really hard for me to place a number firmly on it.
And what we're hearing is that there are a lot of factors that are limiting uptake, including the amount of debt people are carrying, the feeling of lack of trust with local government, with banking institutions. We have heard people in some communities who own their homes free and clear are reluctant to take on debt at all. So there are a number of, and as you say, every community is different and their obstacles are different. But that, I think, is our last question. If anybody has any final thoughts, I think we're ready for Catherine to do the wrap up. And as Executive Director of the Casita Coalition, I do want to thank all of you panelists and presenters for joining us and sharing your information, and to all attendees. But I'll toss it back now to Catherine.
Wonderful. And again, I'd like to echo what our director has just stated. We've had a fabulous group today, fabulous questions. And again, I'd like to thank all the sponsors and the presenters for today's session on behalf of the Casita Coalition. We invite all other small housing professionals, as well as community-based organizations and homeowners to add their voice and join the conversation by becoming a member and donating to Casita Coalition at casitacoalition.org. We would like to also note that there are a lot of resources on our website, including guidebooks on subjects such as garage conversions, ADU finance, and multifamily ADU. Link to our webinar library, or visit our YouTube channel, and many more resources for both ADU professionals as well as homeowners. Join us for next month's webinar on Friday, March 24th, where we will have an update on ADU legislation. You can keep up to date with all of our events and small housing news by joining our mailing list or becoming a member at casitacoalition.org. This is Catherine Peoples, Executive Director of HPP Cares and board member for Casita Coalition, and I'd like to thank you all. Please travel safely as we move through this fabulous day of rainy weather. It's been an honor.